Hello, everybody, and welcome to the latest episode of High Stakes. I'm Paige Soya, the managing partner of K Street Capital, and this season's podcast is all about inside baseball. So all the things that people wouldn't know if you weren't working in early stage VC or angel investing or a founder in that area. And so today's episode is all about the art and science of diligence for early stage venture capital. And we've got an incredible guest with us, one of our co-investors, and I think one of our best portfolio companies, at least on our end, probably the same for you, but Matt Gittleman, who is an early stage investor at a family office locally here with us in DC. And before we get into it, Matt, why don't you give a quick intro and some background about what you do?
Absolutely. And so excited to be on the podcast today, and appreciate the opportunity. So yes, I do. I work with a small family office here in the area. I do all early stage direct venture. The principal I work for has been at this for 30 plus years. And so when I joined 3 years ago, we had just over 100 active portfolio companies. That has grown to just over 140 at this point. So we are quite active in market. I've been doing about 10 to 15 new deals a year. And this year, as we can maybe get into a little bit, it's been a little bit slower, and there may be some reasons beyond that. We've done about four new deals this year. But one of the things I learned early on, when you write small checks out of a family office, in some ways more the extension of an angel investor, is that it's sometimes hard for other institutional investors to kind of remember who you are and invite you in on some of their best opportunities. And so one of the other things I work on is a networking organization here in DC, aptly named VC in DC. We have 700 plus institutional VCs as members across about 300 firms, 2/3 of which sit somewhere between Richmond and Baltimore. So definitely a heavy focus around this region. But I think that other third is sort of indicative of kind of what's happening here in DC, which is that you're seeing more and more investors spending time in this space. And that's giving me access to a national and regional set of institutional investors that sort of the average angel investor doesn't always have access to. And I found that it's been incredibly useful in being able to support portfolio companies and also in getting access to great deals, both locally and then nationally. So that's what we've been up to.
Awesome. And you guys do a great job with that, honestly. I love the events. I haven't been to all of them, but they're phenomenal. And you do a great job of connecting the right people. And it's pretty wild how much the venture space has grown in DC. Like, you've seen it yourself from building that organization out on the side. But I guess we can get into the meat of the topic, which is really like the art and science of diligence and how that all works for early stage venture. And I guess like the first thing I wanted to bring up is this concept of scorecards, because I don't know if this has ever come up for you guys, maybe not in the family office setting, but it often comes up with like angel groups and syndicates where they're trying to make a decision, and each group works differently, and they kind of want to codify what the score is if they want to move forward with a deal. And I guess there's something kind of similar on investment committees and things like that as well with other fund companies, but we really hate that, and mainly because we feel like the scores, they're not always indicative of the reality of how you feel about they always can be gamified, basically, right? Like, if you want to invest in the company, you'll just adjust the scorecard so that it meets that criteria, and it's not really as unbiased or thoughtful, I think, as people think. So I don't know, I only bring that up because I hear about it a lot, and I think it's sort of a strange part of a diligence process, but I'm wondering if you've come across it before.
Yeah, I'll say I think rules are meant to be broken in early stage venture, right? And so I think it's good to have a framework and a rubric for how you're thinking about which aspects of a company you're going to lean in on. But at the end of the day, I look at every deal in terms of kind of what I call levers and hurdles. And so what levers is the founder, is the executive team able to pull to make themselves seem more attractive? And if they can pull hard enough on that lever, it can actually outweigh some of the hurdles, the things that might have been less attractive about their opportunity, right? They've been in market for, if they're raising a pre-seed or a seed round, they've been in market for 5 or 6 years. Well, that's potentially a bit of a hurdle. Like, what has sort of taken them so long? But on the flip side, maybe the founders had sort of been part-time somewhere else for those 5 years, and they just happened to organize the business as a company 5 years ago. But really, didn't start doing anything until the last 12 months. And now all of a sudden they're at 600, 700, 800K of revenue. And so that's kind of the lever that they can pull on to kind of get over that hurdle. And so those rubrics of, team is so important are absolutely true. And doing a score of, 4 out of 5 or, 8 out of 10, I think can be important, but I think that you can't just add up those things at the end of the day and say, well, this company got a 45 out of 50, and so we're definitely going to invest. But instead, it's sort of a reminder of the things that you as a firm find important, and then are willing to kind of work around or work with as you find things that excite you about something. Maybe you find out that the market is considerably smaller than you originally thought. But the exit opportunities in this space are really ample. They're everywhere, and getting in at a good entry point means you still have an opportunity at a pretty substantial exit in a maybe short amount of time. So the framework is important, but it shouldn't be the thing that dictates whether a deal gets done or not.
Yeah, I totally agree. And I think that you couldn't have said it better. Thank you for giving those examples for everyone, because I think the reality is it's kind of like, and of course, we'll talk more about the details and the things we look at in diligence and how this all plays out. Anyway, all that being said, I totally agree. We have our own framework also for diligence. And of course, we put our own investment memo together for every deal that we do based on that framework. But we don't really, do you guys assign scores when you do it?
I don't, no.
Okay, yeah. Yeah, I think that's the thing that I don't like, is the assigning of scores to come to a conclusion. It really is, it's tough. I think you have to look at it so much more holistically, which is the art piece of diligence.
Yeah, and it doesn't look to the weighting, right? So if in some cases, it gives us a flat score for everyone, but if you find an absolutely exceptional founder, that in a lot of cases can create a heavier weight on the team aspect. So if you really want to get scientific about it, you'd have to say, well, in this case, I'm adding an extra 10% of value to the founder metric versus something else. And so you're basically just building in sort of gut instinct into a formula, which is challenging.
Silly. Yeah, exactly. Yeah. Okay, so I think this is an interesting topic that you've brought up with me before that I think is worth touching on, which is, how do you evaluate founders when they don't have any traction yet? Or how do you diligence them, I guess?
Yeah. So I think when you're talking to founders that don't yet have any traction, sometimes don't have product, you're really looking at, I think, their ability to have a vision on what can be. And their ability to communicate that vision. I think the communication piece there is probably the most important thing. We just invested in a company that is pre-product, pre-revenue, but they're existing in one of their investors in the round, and then the CEO, the founder, was able to so clearly define the problem that just resonated so obviously with me, that it didn't matter that they didn't have product yet. It didn't matter that they didn't have customers yet. It's a bit of a risky one. It's a big swing. There's going to be a lot of regulation that's going to push back on it. There's unions that might push back on this. But there's a shortage of workers in this space. They're coming in with a sort of agentic solution that can be enhancing of what humans can do today. They can fill in the gaps where humans don't exist because of the labor shortages. And the value proposition there was incredibly real, and it wasn't hard to build a big market out of it. But the founder has to be able to do that. And for me, I don't look at as much at hard to understand deep tech companies. I'm a team of one. I don't have a technical background, and so once I get into that deep tech world, now all of a sudden I need to see some traction. Right, I need to see customers responding to this. I need to be able to understand that this is something customers actually want, and that this is, and when I looked at cybersecurity for 4 years, I would think about it in terms of, is this a better mousetrap? And I was not the one to necessarily determine that. We had other folks on the team that could do that. But for the companies I'm looking at, I'm really interested in how the founder, the CEO is able to define that vision for kind of what comes next in the next 12 months. How are they going to get there? Who their first customer is going to be? How confident are they that they can get to that first customer? Whether it's a design partner, which is a word we could probably get into for a whole podcast episode of what a design partner actually means and what value they bring to the business. But it's that communication piece for me. And then also it's their sort of work style, right? I'm a small investor. And so, it's in some cases, I don't blame founders for, maybe taking a little longer to get back to someone like me. I'm not going to fill out a round as much as someone else. But the good founders who are raising rounds typically operate the same way I think they're going to do with customers. And they're quick. They're on top of everything as absolutely fast as they can. And I think that speed and that communication style shows sort of this kind of grit, whether it's a big customer or a small customer. And eventually they'll need to, move away from founder-led sales and have someone else who can do some of those things. But in the early days, it's so important to be able to just evaluate sort of their work ethic as quickly as you can, because sometimes we have a week to decide and sometimes we have 3 months to decide.
Exactly. Yeah. And I think we think about it the same way. Part of the process, yes, we have our things that we want to look at. We want to look at the cap table. We want to go through the model. We want to look at the customers, whatever. We have our things that we're going to go through with the founder and the team, but the way that the team responds to those things and communicates and articulates their answers is really more important than the actual things themselves in a lot of cases. Of course, the things matter, but that is half of what we're diligencing, is that sort of aspect of it, and not just this is why I really struggle with the concept that AI could do the kind of job that we do, because there's so much of it that is, I think, qualitative and based on the way that somebody responds versus just looking at the information directly and making a decision. So I think that's definitely true. And remind me, are you pre-seed investors or seed? Or
we will invest as early as pre-seed. I mean, this company we just invested in had got organized 6 months ago and has been building product for 3 months. Okay. So they're really early on.
So you'll do pre-seed through what, like
Series A, I would say.
Yeah,
the economics of a Series A when you're writing a sort of sub 100K check or even up to 250 on an SPV are such that it becomes sort of challenging beyond that. But we opportunistically can take some swings later stage as well.
Okay. Yeah, I mean, we're the same way. And I think that we don't do a lot of what I think of as pre-seed. We mostly do seed or seed plus when there already is some traction. That's why I like this topic, this question, because a lot of founders, of course, you don't have traction in the beginning. So what do you do if you need money to get to the point of having traction? You have to raise it somehow. And for us, it's pretty hard to raise money from us at that stage unless it's a founder that we've invested in before, or it's a second-time founder that's very clear that they know how to build a business from 0 to 1, or if they have some sort of really unique domain expertise and like network access from their experience that enables them to sort of like take over a market quickly. Those are the kind of things we think about, I think, more than the product or the feature set or the tech itself, because I think those are the things that seem to matter for us anyway at that stage, before there's revenue, before there's customers or any of that. But I guess I also want to ask you, on another topic, what you think about what if founders often overlook when they're talking to early stage investors, whether they have traction or not, like when they're looking to raise capital.
I think a lot of times founders they're so day to day. They're so in the weeds with putting out the fires, with cash flow, with paying their employees, with things that really matter. It's sometimes hard for them to take a step back and be able to articulate the big vision of what the company can be. And I see that with companies at pre-seed. I see it with companies at seed to A, and in fact maybe more from seed to A than anywhere else, because you're no longer pitching on vision, which is what kind of a pre-seed is. You're kind of pitching on, but at seed you now have something, right? We can get into what pre-seed and seed and A mean, and if those are the right definitions. But for now, I'm thinking about a seed is a company with $500,000 to $1 million of revenue, which is probably more than it used to be for a seed. But nonetheless, it means that they are actively dealing with customers on a daily basis. They want to make sure that they're not they're avoiding churn. They want to make sure that they're signing new customers. Like at a point where you have no revenue, I sort of used to joke that it was easier to raise at a higher valuation at pre-revenue than it is at revenue, because as soon as you hit revenue, you're now tied to some multiple, fair or unfair. But at pre-seed, it's all just on the vision. And so raising pre-seed at a $20 million valuation seems more realistic than a seed deal that already has $1 million. You don't want to pay $20 million for a company with $1 million of revenue, and it happens. But you're now tied to some number. So coming back to your specific question. Founders are so in the weeds with the fires they need to put out that day that sometimes, as they're trying to articulate what the Series A and Series B and beyond potentially look like, they're really talking about the value that they're creating today, which is important in terms of maybe setting sort of the price of the company today. But the opportunity is really on what comes, 24, 36, 48 months down the road. And I find that sometimes it's hard to think about that kind of phase 2 or phase 3 of the business. And I think that's sometimes where like a pre-seed or seed investor can be really useful, because they're not day to day in the business, and they're constantly thinking about, okay, what does this become? And so helping them think through or just articulate the things they know are in the founder's head can be, I think, really useful.
Totally agree with you. And I'm sure you do a lot of that when you meet with founders, especially at the pre-seed. I mean, it's so important. And for us, it's also, I think it's important for founders to, when I was a founder, right? I was a fintech founder. I don't know if you remember this, but
Yep.
when I was raising money on the other side of the table, and also like for the first time, and I think I would make this mistake all the time, is that I didn't really understand from a VC investor's perspective, like what they're trying to get out of it. What's the opportunity mean to them versus to me? And how do you articulate what's the time frame to the returns on this investment? Like, what does that actually look like for the investor that you're talking to? And it took me so long to figure that out. And then once I finally figured it out, it was such an unlock, because I think it's like we all, maybe not as much for you, Matt, I don't know, I'd be curious your perspective, but from a family office perspective, maybe it's a little bit different because you have more flexibility around it. But from a fund perspective, we have our portfolio construction, and we know exactly what the timeframes are and how many bets we want to make in each sort of category, and how much time we want before they exit, and what the multiple needs to be for it to fit into that that space for us. And so like, that's something we think about with every single deal constantly. Yeah,
we have a little bit of it's not a fund, right? Everything is deal by deal. We have so many companies that we've invested in, and at 140 plus at this point, that the maturity of and been doing it for as long as he has, and now me jumping in and doing it on their sort of behalf, we see exits every year in up markets and down markets. Some exits are better than others, and that matches some of the macro. But we think about, our average time to exit is 10.4 years. At least it was when I started 3 years ago, and that maybe will change, maybe has changed. But we know that pre-seed deals are going to take that long. We know that seed deals are probably going to take that long, or at least an average between those two, which is where we normally start. But we can afford that because of the history of how many investments we've made. And so we are still seeing that kind of DPI every year, maybe not at the rates or the size we'd like, but we're still seeing it happen because of, I think, that long history there, and just candidly the number of the volume.
Yeah, exactly. And I mean, it's the same for us. I think at this point it's not I shouldn't say it's the same. It's a little different. But also, if you remember, and for those who don't know us that well, we have a syndicate that does direct investing.
Yep.
And that's a whole bunch of different individual investors who we pool capital with, and they all have different priorities and timelines for why they decide to invest in one thing versus another. Mm-hmm. And then we have our fund, which of course is professionally managed, which is what I was talking about earlier, where we have a very specific way that we're thinking about portfolio construction. And so I think those two things are a little different, but they sometimes go hand in hand, interestingly. And I think we have 85 portfolio companies now, so over time. And how many did you say you guys have?
142.
Yeah, 142. And in total, or active ones?
Active, probably 215 that total investments in individual companies over the last 30 years.
Yeah, that's insane. Yeah, so I mean, a lot of activity there and a lot of, I guess, flexibility and opportunity to do things with capital that comes in from exits and decisions that you want to make with them. But I hope that when founders listen to this conversation, that's a takeaway or an unlock for them by itself, right? You and I both invested a lot in the same type of companies. We've co-invested in deals together before, but we're very different types of investors. We have very different strategy around that. And I think understanding that and being able to articulate how the opportunity fits in for which type of investor that you're talking to as a founder is one of the big things that does get overlooked.
Yeah. And I'd add one thing to that, because, of course we're always focused on companies, eventually getting to an exit. Right. And we've been, historically pretty patient with that. I mentioned over 10 years. My sort of measure of internal success, which allows for a slightly shorter time frame, is how many of our companies can get through a successful Series A. That's really the length of time that I can personally sort of be supportive of them. I can introduce them to a handful of Series B investors, but those Series B investors, if the company is doing their job, they're already identifying them, at that Series A or even earlier in some cases. But if I can be the one to help them raise that seed round, raise that Series A round, I know that I've done sort of as much as I can within the context of being a small investor and leveraging the VC and DC network and my own kind of personal one, to be supportive up through that point. And most companies don't reach a Series A. So another measure sort of success, especially in this market. I mean, the number of bridges between seed and A is probably 5, 6, 7x the number of actual A rounds that ever take place.
Yep.
And so if we can get them through that really tough transition period from kind of early stage company to starting to become a growth company, I think we've done our job. And of course, there's only so much that we can do, and they should take very little credit in any of that. I want to be clear about that. But the one thing that we can do is help them articulate that story and get them in front of the right people who are going to hear that story and get excited about their future vision.
Exactly. Yeah. I also just want to share what we look at from a diligence perspective. Like, I just pulled up one of our data rooms that we of course, founders will send us their data room, but we make our own data room with some of their stuff and some other stuff. And I think it's worth sharing I guess this is more the science piece of it, but the things that we look at are, the cap table. There's not that many, so this won't take that long, but there's a few core areas. Like, we look at the cap table, we look at the competition, we look at, of course, the corporate docs and investment docs. We look at the financials, financial statements, their projection, their pipeline, their cash flow, all of that. We also look at their kind of like they don't always give us this, but we put it together like a cap table waterfall of what does this look like over time with dilution that we expect based on when we think they're going to be raising, or how much they're going to need to raise. Then we also put our own investment memo together, and that's part of our data room, right? That's kind of the maybe scorecard-y type thing that we do, I guess. We look at the deck, we look at the term sheets, we look at all the investment docs, the market, their customers. We also do interviews. Of course, we do like our own internal reference checks and external ones that the founder may or may not know about. Yep. But with we meet with their team, we evaluate their team. This doesn't really go in our data room because it's much more. I mean, we have notes on it in our data room, but it's much more. You have to kind of experience it to understand if it's good or not, I guess, versus just looking at the notes in the data room. And we talk to their other investors. We talk to their lead investor. If we're not the lead, we talk to some of their major and minor investors that have been with them for a long time, like some of their smaller pre-seed investors that have known them for a while and can speak to how they've built it over time. And those are the core things that we look at from like a science perspective. And I'd be curious if that's kind of in line with the things you guys ask for, Matt, or if there's other things.
No, I mean it's absolutely in line. So I spent prior to this role, I was with a group called Blue Venture Investors for 4 years, where we also had co-invested in some deals together. And they had a framework that they called the 5 T's, and I'm not sure if they came up with it or not. I'm sure it exists in business school classrooms everywhere. But that's team, technology, traction, TAM, and terms. And so I think a lot of the things that you just talked about, in some ways, kind of can get boiled down to some of those types of things. It's a little pithy to just to say that those are the only things that matter. But I'm really eager to dig in. I start with the team. It's always the first person that you meet when you actually. I'll back up a little bit. It's actually not the first thing that happens, right? The first thing you end up doing is you see a deck and you have to sort of
True.
get excited about that, or maybe another investor or a founder or someone else in the ecosystem tells you about a company, and you'll hear a little bit. You'll usually hear more about the company and the product and the technology than you will about the founder. So that first pass ends up actually being the sort of the teaser of what the company is or can be. And then the absolute next thing, if that you make it to the next step, is going to be the team. And I'll go back to something we talked about earlier, which is one of the things that is actually not a true diligence checklist item by any means, is just the interactions you have with the team. And it has nothing to do with the reference checks. It has nothing to do with your research on their background of what they have done or have not done. It's really just, do you sort of get along with them? And I doubt many investors have made many investments with founders they simply don't get along with. Yeah. I'd be interested to know what that number is, because I'm sure it's very low. But that goes back to this, to that back and forth communication of when are we going to meet? Okay, now how long did it take you to get back to me on that, or how long did it take me to get back to you? And there's this sort of like this respect sort of building right off the bat in terms of how you're actually going to be working with them before and after. And then both of us, both the founder and I, are sort of in sales mode in some way, right? I'm selling the fact that I write a small check, but I still should probably be, I should have some allocation on this round. And the founder's going back, and if they want me in the round, they're selling me on the same thing. And so that sort of back and forth interaction, I think, starts to build rapport. And the companies that I feel best about are the ones where I really feel like there's that good rapport. Now, I think you can get a little blinded by that too. Like, you really like somebody, she or he just it ends up becoming someone you kind of just want to hang out with and talk to. And so then you have to really make sure you're able to kind of separate that from what the rest of the business is. I am, being such a small investor, being somewhat spread thin, like all of us are in different ways. I do, as much as I can, try to lean on other investors to learn from what excites them on it. I sometimes come into rounds as sort of the one of the first investors. We're not writing checks as that first investor. But if we believe in it, we'll introduce them to K Street or to other firms in the network and see if they want to sort of start a diligence process with them. And if they don't, that's sometimes an indication that maybe we won't either. And so getting those feelers out, especially for folks with domain expertise in one area or another, is a really big one for me. And it's simply because I can't do all of that by myself. And I think our check sizes dictate that we're not going to be the only investor no matter what. I'm hyper concerned about runway. So, writing such a small check, someone says, why don't you invest now? The terms are a little better. But it really means they still only have 2-3 months of runway left. And to me, that risk is just too great. I need to see the ability for multiple shots kind of on goal, kind of metaphorically there, in terms of their ability to kind of see this thing through. So introducing them to someone who can write a bigger check and get excited about that business is great. And in cases where maybe we have invested in what I would call an opportunistic bridge round, where the company has enough cash reserves to last another 18-24 months. In that case, I don't really need to invest alongside other investors, because I feel good about their ability to kind of keep going. So we lost your initial question there a little bit, but
no, I think that's eye-opening for people to hear, because those things may not be things that you would see that you would be asking for in a diligence process up front necessarily, but they come up as you go, right?
Mm-hmm. Absolutely.
And it's true. I didn't mention that either, but we're writing a slightly bigger check, but we're also not going to take the whole round. Of course, we're usually 25 to 50% of the round, so there's going to be other investors involved, and we need to make sure that they are involved in order for it to meet the cash flow projection that we have planned out that we think is going to work for them. So we do. I mean, we invest in a lot of different regulated markets too. So we're not experts on everything. We learn a lot in each deal that we look at, and that helps us inform us on the next deal. But again, like you really want to get some of these expert outside opinions about certain things along the way, especially technical things. Probably the same for you, right? If it's a very technical company, that's not, we don't have a lot of in-house expertise, but we do have a big network of people who we know very well, who are investors of ours, who we can share it with, and they will give us their feedback and tell us what things to dig in on, and tell us if they think it's a red light, green light. They might even hop on diligence calls with us sometimes, depending on what the situation is. So that's part of our process, and I don't know how common that is with other funds or firms, but I do think that's it's not something you would see in our data room. It's not like on our list that we give founders of something that they're going to be doing, but it does come up. Yeah.
Yeah, that makes sense.
And then I guess I wanted to ask you, is there any other topic that you think is worth bringing up before I ask you my famous 3 questions? Did I miss anything? I mean, I'm sure we could talk about diligence for literally hours, given that we spend a lot of time doing it ourselves.
Well, I think one of the things that's probably worth mentioning to kind of these pre-seed and seed stage founders is how to kind of get in front of investors. That how do you get that first kind of conversation? And I think that first of all, it can be hard. I think that the cold outreach is, you can pretty easily do it and send out 1,000 emails, and maybe you get a couple bites on it, but the percentages are going to be very low. In those early days, it is the founder's job, if they want capital to go build a business, to be essentially in sort of full-time visionary and fundraising mode. Mm-hmm. And that means you really have to get out into the community, and you have to go talk to investors at events. You have to run into them. You have to ask for coffee chats afterwards. You've got to build up that network. If you have it already, great. You're one of the sort of lucky ones to be able to do that. But if you're not, there's no really fair way to do it other than to just show up again and again and again and again. And if you don't, not everyone wants to be the extrovert who goes and meets people. But unfortunately, in most cases, without a track record, you're going to need someone who can do that. And so if that's you, great. If that's somebody else, you're going to have to be able to sell one person on that vision to be able to put a lot of their life aside to go build on your vision. And so I think that getting in front of investors can be a challenge. I look at 500 companies in a year, and this year we'll probably do 8 new investments. We did 14 last year. But looking at the deals that we ended up doing were ones where, again, the founder was really leading the conversation and got in front of us in a way that caught our attention. And the cold email is not a great one. We try to look at as many of those as we can. I know we've missed great companies that have come through the cold. But there are things you can do, from, kind of like a little bit of LinkedIn stalking to, looking up what events are kind of going on in your region and trying to show up and network your way into some of these things. But you probably need to dedicate a good amount of time to trying to build up that network as soon as you can. And I always tell founders the best time to meet your investor is 12 months ago, because they want to get to know you. They want to build that relationship as best they can. And I've invested in companies I met, a week earlier, and that's rare, but it can happen. I would have much preferred to have met them, 6 months ago or a year ago, to hear about, what it is they're looking to build. And part of that on our side, on the investor side, comes from being in this industry, hanging around the hoop long enough and building networks and building relationships so that second time founder starts coming around. That you can't meet second time founders as your first job and venture. But being in the industry for a full cycle, that 10 years, you start to see founders, start to come around more and more and more.
Exactly. Yeah.
That's It's a hard
Yeah,
thing.
I mean, you're exactly right. And I was going to mention this earlier because I can't remember what we were talking about, but the thing that's so important about the founder being one of the most important things in the early stage company and the team, which doesn't necessarily show through in the science piece of the diligence, is why it's important to meet the investors earlier, because it takes us time to get to know you and to really like understand you and understand and trust you and feel like we want to back you as the as the leader of that company. And I think that's like we meet with founders all the time that maybe we know they're kind of in our space, but we know they're maybe a little too early, or for whatever reason we're pretty sure going into the call that we're not going to be writing them a check, but we still want to meet them anyway.
Yep.
And we want to stay in touch with them. And sometimes there's been founders we've invested in who we met with every year for 5 years and didn't invest until 5 years later and then wrote a pretty big check. So, it does help to do that. I'm sure that founders, when I was a founder, I'm like, this just distracts me from building a business, and I should be focused on building the business, not like running around talking to investors over and over and over again, getting not a check from them. But that is part of the job. That literally is part of the job of being a founder of an early stage tech company.
And I would add one thing to that, which I think is so important and sort of somewhat forgotten. If you can make an impression, whether you are a good fit for that fund or not, I can't tell you how many companies I end up, at an event somewhere that maybe I'd passed on, we didn't invest in last month, the month before, 3 months ago, but the founder made an impression. We had a good conversation, and all of a sudden I'm talking about that company to 2 or 3 other investors. The founder has no idea that it's happening, but all of a sudden, like, you start actually sort of like showing up kind of in the ether because you made that good impression. And so I think
it's not wasted time.
Right. VCs should do a better job, I think, and I certainly need to do a better job of sort of being faster in sort of communicating, yes or no, less requests on, just sort of follow up for the sake of follow up. I really try hard to be tight on that. But at the end of the day, if I know more about your business, I now have more to share with other folks that might be interested. So it's really just a marketing exercise in some ways.
Yeah, 100% agree. Okay, so I have 3 questions for you. Maybe you've thought about them before, maybe you haven't. Mm-hmm. But what's the most interesting inside baseball thing you've learned about venture capital?
Relationships.
Surprising, yeah.
Yeah. Relationships matter so much at the pre-seed. As soon as you are getting into later and later stage deals, of course, relationships get you access to sort of earlier stage deals. But there is no better way to get involved in the deals you want to get involved in than by being a resource and being friendly and being supportive to as many people as you can. And of course, you have to be defined in what as many people as you can means, because you will spread yourself too thin and be useful to no one. But developing and building the relationships with the folks that have a similar worldview to you, a similar thesis to you, is, for me as a small investor, the number one way that I can play a part in a larger venture ecosystem.
Yeah, and I will say, for anyone that doesn't know you, Matt, you do a great job of that. For all founders, for other VCs, it's definitely one of your superpowers, for sure.
Thank you.
What's your biggest failure, and what did you learn from it? And this can be venture or not, up to you.
Yeah, I'll stick with the venture side right now. I think that my biggest failure is not following sort of our own advice about founders are at the center sort of everything. I talked earlier about this concept of hurdles and levers. And when the opportunity size for a particular technology felt like it was just so big, I started to look past some of the things that maybe didn't work as well with a founder. And so knowing that the communication style wasn't what we were looking for, knowing that the responsiveness, that the sort of the ability for this founder to potentially fundraise in the future, it always felt like it all hinged on the technology working, which it was too sort of early for us to actually. It was more on the promise that it would work, and that if it did, that the market would just pick it up because there was no other way forward for this industry to go forward without something like what they were building. But the founders still mattered more than just about anything at that kind of pre-seed, pre-product, pre-revenue kind of stage. Yeah. And that's a lesson that I still see companies where I get super excited about some aspect of it. And I have to say, well, how does the founder match that technology? How do they match a venture company, right? Do they have to match not just, founder tech fit, founder product fit? They have to match founder capital fit, right? Like, yeah. Are they the right founder to be raising venture capital? Right. Because there are other ways to build businesses. Venture capital is a sort of accelerated version of some of those other means, but they have to be able to do that.
Yeah, 100% true. I think we've all made that mistake. I don't think there's any investor out there that hasn't had that sort of learning in the beginning, right? Like, it just always happens, and you have to be so careful about it. And then on the other side of the table, what's the best advice you've ever received?
Differentiate yourself. Investors, all talk about their individual incredible value add, and how useful they're going to be to a company. Some investors differentiate themselves with through Twitter or X, through blog posts. They do it through their past experiences of being an operator very successfully, through exits that they've had. Some of it do on their own singular track record, and those are probably some of the better ones in some cases. Although past performance doesn't dictate future performance always, but differentiating yourself in a sort of crowded sea of investors, I think, can be challenging. And when your check size differentiates you in a bad way because it can be so small, I think you have to lean into other things that allow that make investors want to be a part of what you're doing. I'll give a short plug for an event we're doing with VC and DC. We're hosting an event we call Missions and Markets. I think it will be just about to take place when this podcast comes out, where we connect dual use founders and investors together. But I bring it up because one of the most recent investments we've made was a company that's based in Texas. They're going to be selling to both the commercial sector and the public sector. And when I told this VC about this event they were coming up, they said, I have this deal for you. The round is oversubscribed. They're not really letting anyone else in on it, but it seems like you could be a real value to this. And so I talked to the founder about 45 minutes later. We just got on a call because I knew the round was already kind of done. And I sort of said, listen, we're sitting here in DC. Your investors, none of them are in DC. You've got all sorts of government customers that you're going to want to get access to. My Missions and Markets event, the VC and DC community, these are all things that I can provide access to. And that was my differentiation when, everybody else was a bigger name fund. None of them were in the DC area, but it allowed us to go and organize a small SPV. And we wrote just a check just shy of 100K in an oversubscribed round. And that was that differentiation. I try to think about that, about how the VC and DC community differentiates me from a lot of the other investors in this market and in others.
And I should know this, but the events that you create, like this one you just mentioned that's upcoming, they're very specifically, they're not public events, right? Or are they? Well,
so we host a lot of events that are VC only. We do about 12 at least of those a year. We run a happy hour every month, and those are VC only. And that's the reason for that is that there are lots of great communities here in DC, and a lot of them consistently bring founders and investors together. We try to create a sort of curated community for investors to better get to know each other and to be able to sort of candidly talk about what they're seeing in market, about their careers, about opportunities they're seeing in market, out of market, and have a sort of more free-flowing kind of conversation around those things. But we also recognize that this community does not exist without the founders. And so we more and more try to create opportunities for that kind of matchmaking, or just kind of high collision type events where, we're this missions and markets event. We've got 30 of some of the best dual use investors in the country, most of whom are here, but some of whom are coming from pretty far out of town. And we're creating 4 highly individualized matches for each founder to meet with one of those with those investors over the course of a couple hours. And then we're going to bring in a much larger group for sort of an open happy hour afterwards. Now that open happy hour still reflects high impact sort of industry folks who are at some of the biggest kind of startups and companies building in sort of the defense spaces, the investors and the founders. We keep things like really tight around those, so they are public if you sort of meet those criteria, and we do that very intentionally to make sure that everybody comes out with, our sort of goal is to say, how many follow-up meetings did you have from one of our events? And our goal is that it's 1, 2, 3, 4 plus as you kind of go out into the world and hopefully meet some new people. You get to catch up with people you already know, but that's sort of how we think about the events that we try to put together.
Yeah. I mean, they are fantastic events too. So I think it's like you really need to have that value add on either side. And I think being able to offer that to founders is, I mean, it's incredible. Like, especially if it's a founder that doesn't have a natural, to your point, like a natural, I think you mentioned an example of this, but if you're not really connected in this ecosystem and you don't know a lot of the players that match your specific category that your company fits into, then how are you going to find them and learn about them and meet them and build relationships with them? And if that's something that you can offer them, I mean, that's huge. That's really big, and that's time consuming, right? Like, I know it is. So I can't also just thank you enough for doing that for the ecosystem here in DC, because I think it's very needed. People really appreciate it, and yeah, I think it is really good advice. So, well, that's a wrap.